Good morning. Good morning. Hello. Hello. Let me get situated, getting set up here. Welcome back to Faith and Financial Literacy Live. My name is Adora Kimberly Akachuku, and I am your host. Here on this platform, Faith and Financial Literacy Live, we do not believe that God and finances should be separate. So we oftentimes talk about the principles of wealth God's way. We dive into scripture and find out what scripture says about finances. And we'll even talk about practical ways that you can build a strong financial foundation for you and your family. And so, what we're going to be doing on this episode is more of the latter. We're going to be diving into some practical principles, some practical steps that you can take. I have a handy dandy whiteboard here that I just bought. So, this is going to be my first time actually on live using a whiteboard. So, let's just see how this goes. I haven't even practiced with it, but I have an idea of really what I wanted to share today. What we're going to be talking about is we're going to be going into a few concepts, a few principles, and the idea is this: just to set the stage for this conversation. I want you to be aware of some things. Here in the U.S., let me even start with some even more recent relevant news, and then I'll work my way to the meta overview of what's kind of going on right now. So yesterday, Walmart released earnings, and their earnings were the lowest in a quarter that they had seen in the last 6 years. Now, when Walmart's earnings are low, and think about it, Walmart is the largest company in the United States, in the country. When Walmart's earnings are low, that is not a good indication for the American people. What it essentially signals is that economically speaking, people are struggling because Walmart is where people go to get their everyday items, right? Walmart is for essentials. Walmart is where the everyday American shops. And so if they are cutting back on their spending, that means that they're really feeling the pinch economically. They're not able to spend as much. And what that essentially signals to the economy previously, when we've seen this trend, is that we are in a struggling economy. And that is what we saw. I mean, I feel like a lot of us already knew that just based on, I don't watch the news, but if you're not living under a rock, if you're not ignorant, you can see that things are rising very rapidly. I mean, my husband and I, we've gotten several notifications in the mail saying I think it was our sewage bill is going to be going up $65 a month. I mean, that's just one bill. We got a letter from the mortgage company. Our mortgage is going up $2,000 per month, and because we had an escrow shortage. And apparently, a ton of other people are going through this. Of course, there's concerns about gas due to the war, right? Due to global economic affairs, there is this trickling down effect that the American people are feeling. And so it has impacted their finances. Now, by the grace of God, my husband and I are also business people. We have our own business. And in my business, I'm on track this month to make more in my business than I am in my full time job. And I work in tech, right? I have a background in engineering. Now, when you put that up against the majority of people, right, there are some people who will receive these bills, who will receive these influxes. And I'm not saying that it's fun on our side. Absolutely not. We've just chosen to see this as really an opportunity to increase our financial capacity, really as an opportunity to continue maintaining some of the principles that we decided to maintain, like not carrying a car note. We have not carried a car note since 2023 when I sold my car. Every single car we've bought has been cash. And so essentially, also buying homes, right? We're not going to be buying any home now or in the future that is not based on one income, right? We're not going to be combining our incomes to define our affordability. That's what we did when we entered this home. And even through that, we still got hit with a $2,000 increase. So when you set up when you at least know the fundamentals, you've built up your finances in such a way that it can weather different seasons, different storms. I've talked about on this platform a few times how my husband lost his job a couple years ago. In fact, it was our first year of marriage, and we thought, oh my God, all is lost. We thought, okay, this is the end, right? And because of some of the things that we had been doing, which I'm going to show you in this episode, we were fine. In fact, We saw it now. Now, looking back, we were very well prepared. We were very well prepared. And so, what I wanted to talk to you guys about today is I know, we know that there's people who are struggling. We know that we cannot rely on the government to be good stewards of money to help us, to come to our rescue. I mean, if we look back in 2020, when COVID was going on, a lot of people were impacted. I mean, people were not able to pay their rent. People were not able to pay their medical bills. People were not able to pay their bills, period. A lot of people ended up defaulting, losing their homes. And the government sent a couple $100 stimulus check. Like, what's that going to do? Right? So you cannot rely on the government for anything. And then you cannot rely on your job also because we've seen that your job is not guaranteed. I work in tech. And so in 2022, we saw massive layoffs like we've never seen before. And since then, it's continued. It's become almost like a way of the world now. You never know if you wake up tomorrow and your job is still going to be there. That is the kind of environment that we live in. I mean, due to tech, AI, innovation, we don't know that our jobs are going to be here tomorrow. We don't know that they're guaranteed. So the best thing that you can do for yourself and your family right now is to understand how money works, to be intentional about where you're putting your money, to be intentional about how you're building your wealth, how you're building your finances for you and your family, and also to be aware of some of the principles about money and how money works so that it's working for you and not against you. See, one of the principles that we're going to be talking about today is the rule of 72 or compound interest. And Albert Einstein defined this as the eighth wonder of the world. He says that those who know it earn it, and those who are ignorant of it or don't understand it pay it. So we need to be on the right side of money, on the right side of these principles, so that we understand how it can work for us, how we can make money our slave and not be a slave to our money. So let's go ahead and start with a concept that we call the financial house. Now, a little bit of background about me. If you're watching this for the first time, welcome. Make sure to like and subscribe because you do not want to miss these episodes. This one is a little bit different in that we are going into very practical, we're going into very practical advice, but just a little bit about me. My training is in engineering, but my calling is in finance. And so I started a financial education company in 2021. And what I would do is I would host these workshops for relatively early in career. I mean, I would say I worked with people from the age of 23, 22 to 35. And now as I've grown, of course, my audience has grown with me. But what that allowed me to do is allowed me to practically serve people, to understand what their concerns were, and to address their needs, address their knowledge gaps. And so that's evolved into me being able to coach people one-on-one. And so I primarily coach women. So a lot of women will come to me and say, hey, I know that this money should be working for me. I know that, I have all this money saved up in the bank and it's not doing anything. I know I should be doing better with it, or I just don't know how money works. So I'll work with them one-on-one. So I also have my financial services company. So with my financial services company, anything from income protection, like through life insurance and through investments, those are products and services that I am able to offer in addition to my own in-house digital products and coaching. So we're going to go ahead into the financial house. So let's define what that financial house looks like or should look like. So at the foundation of the financial house is what we call income protection. Now, I hope you can see this. I don't know if it's backwards. To me, it's backwards. If someone can let me know if what they're seeing is the right way, I don't know. But what this says here is income protection. And the reason why income protection is the foundation, a lot of people say, oh, let me just invest, let me just save, let me just pay off debt. The truth of the matter is that if something happens to your income today, whether that is due to death, unfortunately, or whether that is due to sickness, illness, your income is what is holding up your entire house. Your income, the money that is coming in, is what is funding your debt repayment. It's what it's funding your investments, right? It's what it's funding your emergency fund. And so the most important thing that we want to make sure of that in any circumstance, that this house is still standing. And we want to make sure that Fundamentally speaking, your income is protected to protect not only your financial house, but your physical house and those who dwell in it. So, your income protection is the foundation. And what we say is that you want to typically have about 10 times, 10 times your income. Hi, Hobby. Can you see this properly? Can you see this? Is it backwards for you or are you seeing it the right way? It's showing in reverse. Okay. I don't know how to fix that, quite frankly. I need to figure out how to use. My husband told me about this tool called OBS, or having like some kind of camera that can point downward so that you guys can see this the right way. Bear with me. I'm going to be talking through these, and hopefully you can still kind of get it. So the fundamentally foundation is income protection. You want to have about 10 times your income protected. So let's say that you're bringing in $100,000 a year. You want to have about $1 million in income protection through life insurance. Now you can do this through, there's term life, there's permanent life. If you're young, or if you're a business owner, if you're a high income earner, I recommend permanent life insurance. I'll tell you why. 98.9% of term insurance premiums are lost, meaning that 98.9% of the time, that that life insurance policy that is term is not going to get paid out. Now, term is what we mean by 5, 10, 15, 20, 30 years, right? Term. And most of the time, the life insurance company is winning that bet that you are going to outlive that policy. So that is why I highly recommend permanent life. And permanent life insurance also comes with living benefits. I mean, both permanent and term, they come with living benefits, but permanent is money that you can be able to access within your lifetime. And you know that no matter what comes, rain or shine, no matter how many years pass by, that policy will always be in force, provided that it is structured the right way. Very important that that policy is structured the right way. So income protection is the foundation of your financial house. Let's make this a little bit bigger. So the next is going to be, debt, right? So we want to make sure that we have debt management, our debt management, right? So we want to make sure that we have our debt under control. So we want to aim for zero, right? We want to make sure that we're aiming for zero. Now, when I say debt, I'm not talking about your mortgage. Okay, I'm not talking about your good debt. I'm talking about your bad debt, like your consumer loans, like your credit cards that have an APR of 20%. And we're going to see how that is actually working, seriously working against you. So your debt management, we want to work towards zero. Now, that's a gradual process, but that is somewhere that's a desire that we plan to get to. Now, let's talk about your emergency fund, right? So for your emergency fund, we want to make sure that your emergency fund is at least 3 to 6 months worth of your income. Okay. Now, why do we want to make sure that's 3 to 6 months of your income? We want to make sure that if anything happens to our job today, that we're able to give ourselves some leeway to recover, whether that is being able to find a new job. Okay. Whether that's being able to maybe jumpstart our business. If you're maybe already in business, that's an opportunity for you to really crank things up, right? And get to a point where maybe your income is somewhat stable. So we want at least 3 to 6 months. And I really like the principle that, instead of just going for 3 to 6 months immediately, start with $1,000, right? Each of these stages can be built concurrently. We want to make sure, though, that it is prioritized in the right order, that we want to have income protection, that we understand that that is the foundation of the financial house, that we understand that we are working our way towards $0 in debt, and that we're working our way towards 3 to 6 months. I mean, it's not going to happen overnight, but we need to get our priorities straight. And that is what this illustration aims to show, is what the priorities ought to be. And then the top of it is your investments, right? So your investments should be about 20x your annual income. Okay, so let's say this says 3 to 6 months for emergency fund, and this is 20x annual. Okay, so 20x your annual income. Now, why do we say 20x? Now, historically speaking, the reason why this has been taught is because people, from a retirement standpoint, the retirement age is about 59 and a half or 60. Now, if you live until you're 80, right? Or if you build up enough savings until you're 80, that is about 20 times, right? That's about 20 years worth of income. Now, it is a reality that actually most people are living longer. Most people are living beyond 20 years. Another assumption to consider is that by the time that you get to that age of retirement, that you would have paid off the house, you have no car notes. I mean, you're living pretty lean. So if your income was 100,000, 150,000, whatever, 200,000, or even 80,000, hopefully within retirement, right? Maybe your income is slashed, your expenses are slashed in half. Now that is not always the reality, and I'll tell you why. When you go into retirement, your medical bills increase 114%. Something of that magnitude. I may be getting that wrong off a couple plus or minus percentages, but over 100% increase in your medical bills. It is not cheap to be sick when you're aging. It is not cheap to be sick when you're old. That is why it is so important to have income protection, because when you have life insurance, in the case of critical, chronic, or terminal illness, like I said, based on your policy being designed, you do not want a policy that does not have living benefits if you can afford it, right? That policy is going to pay out while you're alive to help take care of that chronic, critical, or terminal illness so that it does not go to your family members. Now, there's some stats that I had. I don't have my notebook here, but I'll kind of paint the picture for you. It is highly likely, and I want to say something to the effect of 60 to 7, there's a 60 to 70% chance that you're going to need long-term care. All right, 60 to 70% of people need long-term care in their lifetime. And when someone needs long-term care, I don't know if you've ever had a sick relative or had someone near you be sick or gone to a nursing home or see what that requires. That requires potentially another family member quitting their job to be able to take after you full time. And that is because the reason why people are pushed to that measure is because they haven't built the savings to take care of them in old age. And so they end up having to quit their job because they cannot hire a nurse. I mean, the average nursing home for a bed in a nursing home, it's about $106,000 for a year, depending on the nursing home, depending on the location, all those factors, right? But it's about 100. It's not cheap. It's not cheap. And so if you haven't built the savings, that's why, I mean, you see old people going back into Walmart to work. You see older people going back into the Home Depots, going back into the fast food, going back into the workforce, because their medical bills have wiped out their savings, or they just didn't plan on time. They just didn't plan early. It's not something that they ever thought about. I mean, we live in a generation of live fast, die young, of, YOLO, you only live once, of, who the world is going to end before then. So why should it even matter? I mean, how many times in the past did they say the world is going to end? And then people, as a result, they stop paying their bills. They stop having kids. I mean, it's foolishness. You can either, think that we're going to live in a utopia and we're going to, live in that kind of world, or you can plan ahead, because whether you plan or not, these things are going to come. People don't, plan to fail. People fail to plan, and that's why they end up in the unfortunate circumstances that they're in. So that's the financial house. So we're gonna get rid of that. Just recap: the foundation is income protection. You want 10 times your income towards life insurance. Debt management, you want to work towards zero. Your emergencies fund, you want at least 3 to 6 months of savings, but start with $1,000. And then your investments, you want to work towards 20 times your annual income in your investment account. So let's talk about compound interest, okay? Because a lot of people don't understand the power of investing early. People think, oh, I'm just going to wait it out, and I'll wait until I get older. I'll wait until I'm earning $200,000 to invest. Silly. Because you can start investing by the grace of God with the way that technology is nowadays. You can invest into fractional shares. And what I mean by fractional shares is that you don't need to buy a full stock. If a stock is at $500, you don't need to buy it for $500. You could buy it for as little as $50. You could buy it as little as $10. That's what I do, right? I have a set amount of money that I put into stocks, into the stock market every time I get paid. Before I even see the money, it's already gone into my investment account. It's already gone into my 401k. My tithes are already removed, right? That is a kind of principled life I have lived, to the point where, when my husband did lose his job in our first year of marriage, we'd already been paying ourselves first. We'd already been, we already had a nice nest egg saved up. We already had, investments. We already had all of these things because we started early allocating that money, and that was something I took into my marriage, and I made sure that our house was built on that principle. And so let's talk about compound interest. Now, there's something that we call the rule of 72. So the rule of 72, what does the rule of 72 mean? It's a financial principle. The rule of 72 says that depending on your interest rate, whatever your interest rate is, divide it by 72, and that is how long it's going to take your money to double. So let's say your rate of return right now, you're in an interest bearing account. Your interest bearing account, let's say let's call it Wells Fargo. You have a Wells Fargo account. I know it's around 0.1% returns, but let's just give them credit and say it's 1%. So that means that for that Wells Fargo savings account, 72 divided by 1, because 1 is a percentage, right? So what does that mean? It's going to take 72 years for your money to double. Okay? 72 years. Now let's say you have another account, okay, that's earning 6% interest. Or let's say 3%, because I think the average high yield savings right now is between 3 and 4%. So let's just call it 3%. So if you have an account bearing 3% interest, that means that it's going to take 24 years for your money to 2x, to double. Okay. Now let's say you have an account that is earning 6%. That means it's going to take 72 divided by 6 is what? 12, right? 12 is going to take 12 years for your money to 2x. Let's say you have an account 10%. Okay. Now in the stock market, right? Average is about 10% of the last 60 years. Okay. 10% over, that's about 7.2 years for your money to 2x, to double. Okay. Now, what does this mean for you? Is it possible that there's other factors that are eating into this money that we haven't considered? How about taxes? How about inflation? Okay. What is the current inflation, rate of inflation? Does anyone know what the current rate of inflation is? Any guesses? And if not, I'm just going to go ahead and tell you. The current rate of inflation right now, 4.2%. And you can look this up. It's between 4.1, 4.2% last time I checked. Okay. The current rate of inflation is 4.2. If you're in an interest bearing account that's only getting 1%, you're losing 3.2%. And we know you're losing even more because really this is 0.1%, but we said, let's make it 1% for being able to calculate easily. So your money is losing 4%. Let's even say the high yield savings account, because everyone is like, oh, high yield savings. It's good, right? Your emergency savings should be in a high yield savings account. It's better than putting it in Wells Fargo or a measly Chase that's only earning you point whatever percent. Put it in a good high yield savings account that's getting you maybe 3%, but you're still going to be losing 1%, right? Your money is still losing money. Now, if we're putting it into other interest bearing accounts, let's say it's in a bond, right? It's just in a CD. I don't even think it's earning you 6%, but let's say it's in a T-bill, or let's say it's in it's a mutual funds or something like that, right? Earning you 6%. Well, really, you're making 2%, right? But at least you're making money. Your money is growing. And then 10%, okay? Really, it's 6% at the end of the day. And that doesn't even include taxes. That doesn't even include the impact of taxes. Okay. So that is why we have to be thinking about this. Now, what does this look like practically speaking? So in this, let's not even including taxes and inflation. Let's say you start out with about $10,000. Okay. So $10,000. It's going to take you 72 years for that to be $20,000. Are you kidding me? Do you want to wait 72 years to only have $20,000? But that's what you're going to have. You're going to have $20,000 in 72 years at 1%. Here, you're going to have, I don't know if this is a good example because all I'm going to be doing is writing $20,000, but you kind of get the point, right? You get the point that The few things you need to consider here. What do you need to consider? You need to consider your rate of return. That's this number here. Okay. This number here is what we call rate of return. Let me remove this 10,000 because I don't think that is very helpful right now. So what do you need to consider in the rule of 72? Your rate of return. Okay. So that percentage at the bottom and number of years. So time. These are the most important factors. Your rate of return and your time. You have to think about that. If you're young, right? That is why one of the most important factors in investing is time. If you're young, now is the best time for you to get into the market. Now is the best time for you to get a life insurance policy. Why is that? Because your life insurance policy is based on a few factors. Now we're going to be moving on to the next concept, right? We're going to be moving on so that nobody can play you. Okay. I don't want you to get played. Okay. I'm here to prevent you from getting played. So let me tell you what your life insurance is going to be based off. Your life insurance premium is based off of 4 factors. Okay. So let's say LI premium, 4 factors. Let nobody lie to you. Know that this is the truth. Okay. Life insurance premium is 4 factors. What are those 4 factors? Number 1, your age. If you are getting a life insurance policy at 25 versus at 55, the 25-year-old is always going to be paying less across the board, okay? Based on your age, based on your gender. I'm sorry, fellas. You guys are more risky. I'm so sorry. But you guys are going to be a little bit more risky. So if you put a 25-year-old male and a 25-year-old female next side by side, similar, health, similar background, the female is going to be a little bit cheaper. Okay. So this is not just for men. We want women to be getting on the life insurance train as well. I don't know why we make it as though men are the only ones that should be getting life insurance. I mean, I don't know if that's what people think, but I just want to dispel that like right now. So age, gender, and then we're going to call this your risk class, or let's call it also your health profile. Okay, because it's similar. Your health profile determines your risk class. So let's say you're a smoker. If you're someone who smokes, if you've had open heart surgery, if you had a history of seizures, if you've had cancer, right? Some health factors can actually end up having you get denied, depending on how risky you are. But if you are relatively healthy, right, you're quite healthy, you're not a smoker, you exercise, your weight compared to your height is decent, you're going to be in the top risk class. You're the top risk rating, meaning this is the best, okay? Not the highest risk rating, but I mean like the best risk rating, okay? And then number 4 is your face amount, okay? So your face amount, what I mean by face amount is $100,000, what your death benefit payout is. So 100,000, 200,000, 500, 1 million. Obviously, if you are getting $100,000 life insurance policy versus $1 million life insurance policy, the $100,000 one is going to be cheaper. Okay, so this is what your premium is based off of. However, your premium, if you are taking out permanent life insurance, like I said, remember why permanent life insurance would be a better idea? Because 98.9% of the time, term insurance premiums do not get paid out. That means that the insurance company is winning that bet almost 100% of the time. So that's why you want to get term insurance. You want to get it while you're young, okay? Because it's never going to be as cheap as it is today. And you want to get it while you're healthy. I have a client right now who, unfortunately, her husband died unexpectedly. Like just out of nowhere. It wasn't like, oh, he was sick and then like he just like, he passed away and they saw it coming. Out of nowhere, he died unexpectedly. And what ended up happening is, of course, if you are a new widow, you have a couple of kids, she has 3 kids. Now she's become a overnight single mother. And just the shock, I mean, it put her into a lot of there was a lot of mental trauma due to that. So she had to go see a psychiatrist. She had to go see different specialists, different doctors. She had to retire early. I don't think people realize the impact of death on their loved ones. Even if it was expected, the impact can still be the same. Different people handle it differently. And unfortunately, as a result of some of these like mental issues, having to retire early, having to go on disability, all of these things, she ended up getting denied for life insurance. And her previous agent did not help her. So I'm stepping in and I'm helping her, making sure that she gets covered because I know what this is going to do for her peace of mind and for the security of her family. See, health is something that we take for granted. We think that we're always going to be healthy, that we're always going to be young, that we're always going to have the option to go back and choose to get it whenever we want. But you don't know that. You don't know what life has for you tomorrow, right? Nothing and no day is guaranteed. You don't know how a certain situation might be the straw that breaks the camel's back and has someone go into some kind of, psychosis. We don't know. Or God forbid, you take something that ends up having you lose your mind. I mean, I saw something about this guy, and I hate to be one of those that, oh, I read this here on the internet, and so I'm going to scare you. No, I don't want to scare you, right? I really believe that, the Lord hadn't given you a spirit of fear, but a power, love, and a sound mind. But crazy things are happening every day. I'd rather get it while I'm young, get it while I'm healthy, get it while I can get it, because when I'm old and I'm unhealthy, I cannot get it anymore. You are not no longer eligible for it. And that is when you're young, you take it for granted, right? You take all of these things for granted, whether there's life insurance, whether it's, investing, you take it for granted. You think, okay, why do I need this? Why? It's not important. Let me just focus on my day to day, but you ought to be putting some money to the side. $10 here, $20, it goes a long way. I'm telling you. And then your face amount, right? And then, like I was saying, your life insurance premium gets paid into two buckets, okay? So those two buckets are, so let's get rid of this. So the two buckets, your premium is distributed into two buckets. So premium, two buckets here. There's something we call your cost of insurance. And like I said, your cost of insurance is based on those four factors, right? So your cost of insurance is based on age, gender, risk, and your face amount. That it will determine your cost of insurance. Now, the older you get, the higher this is going to get. Okay. And then your premium. The other side. So that's cost of insurance. That's factor number one. So that's number one. And number two is going to be your cash value. Okay. So your cash value is whatever is left over. So your premium, we have different premiums. We have a target. Okay. We have a minimum. And then we have our maximum. No MEC. So I'm going to explain what that means in a little bit. Okay. So your minimum is, what is the minimum amount you can put into this that is going to make your policy be in force? Okay. Because there is a risk of your policy lapsing if you don't have enough money that is being paid towards the account, and your cost of insurance is increasing. So that's why I said you want to make sure that you're working with someone that is well informed, that designs it properly, and that tells you in the early years you want to fund it as well as possible. Now, that means reducing your death benefit in the beginning, getting a lower cost of a lower face amount so that you can fund it optimally in the early years. That is what you want to do, because you don't want a situation where this policy lapses because in the later years, you're not putting in enough money. So the good thing about this is what we're talking about right now is the IUL, Index Universal Life. So let me just put that up here, IUL. The IUL is variable, okay? When I say variable, I mean that the premiums are flexible. You can change it. Let's say something happens to your job or something happens to your financial circumstance. You can go from target to the minimum. I don't recommend that you do that, but you can do that. And that is why in the early years, you want to make sure that you max fund it, that it's optimally funded. You put more than even the target. You put even more than the target so that later on, if something happens to your job or something happens to your financial situation, that policy is not in risk of being lapsing. And then the maximum. Okay, so the maximum amount you can put into this policy is what we call the maximum non-MEC. So a MEC is a modified endowment account. Now, because life insurance has many tax benefits, and we haven't even talked about what the tax benefits are, but let me just give you a preview. The money grows tax free. Okay. So in your cash value, it grows tax free. Okay. Now the death benefit is paid out tax free. Loans, when you can take a loan, you can borrow against this policy, that is tax free. And it's an entirely tax advantage account. Okay. So there are tax benefits all around this account, right? That is why high income earners use it. That's why business people use it, because what they essentially do is they'll do a deal, right? Especially if you're in real estate. Let's say you're a real estate investor. Into real estate. I invest into real estate. So as a real estate investor, here's what I would do. I would do a fix and flip, right? And once I got my proceeds from that fix and flip, what my profit is, I would come and stuff it into here. Why would I stuff it into here? Why would I not just like put it in the bank, or why would I? Because of taxes, because of your tax implications. If I'm putting into here, Uncle Sam cannot touch that money. Baby, Uncle Sam cannot touch the money in life insurance. That is why O.J. Simpson, with his case with his ex-wife, they were not able to find any money. They were not able to pull a dime out of this man, because when they went to see, the man owned nothing. How is it possible that he owned nothing? He put all his money into life insurance. Life insurance is the one place that they cannot touch. You cannot touch this money in life insurance. All his money was in cash, the cash value portion of his life insurance. That I took time. I'm a really curious person, guys. When it comes to money, and if someone is doing well, I'm gonna look up how are they able to do it. I studied the Jewish people, and when I tell you they're living, I think the Jewish people are probably the number one people who are using life insurance in America. But us black people, we're thinking, oh, you're trying to scam me, you're trying to get my money, you're trying to. And I'm not saying that there's not those bad apples out there. There's not those bad agents that don't really know what they're doing. But what I'm saying is that people every single day are using these tactics, using these principles, using these strategies to build serious wealth, And this is how they're doing it. So the IRS says that if I am using life insurance, right, because I am removing the burden from the government of having to pay for my welfare, or having to pay for Medicare, or having to, whatever down the line. Okay, they're going to give you benefits through life insurance, because you're removing the responsibility from them long term to pay your social security, all of these things. You're not overloading the system. And so they want to encourage people to put their money in life insurance. And so what they do is they give you these tax benefits. However, there's limits. If you know anything about the IRS, right, there's going to be limits on it. And so to ensure that those limits you're within those limits, you have to make sure that you don't overfund your policy. Okay, that is why it's called a non-modified endowment account, but it's still the maximum, to where it doesn't become that, because once it becomes a modified endowment account, you lose all of those tax benefits. What some people might be doing, especially from some people who are unscrupulous, right? Maybe they're doing some shady business that they shouldn't be doing. They're going to come and try to hide that money in their life insurance. And the IRS says, you can only hide up to this amount, but the rest you got to declare it. The rest you got to, you have to pay, you got to pay taxes on that money. All right. So that's why we call the maximum for non-modified endowment account. So as a real estate investor, you do a deal, you get your profits, you come put it here, and that money is growing at the rate of 72, right? Using the rule of 72, okay? Because this cash value, the way that it's growing, depending on what the market is doing, right? It follows the index, but it is not exposed to market risk. That is another reason why people really like the IUL, right? So some other principles about it. Now, there's something that I didn't tell you. And now you're probably wondering, are we only going to talk about life insurance? No, I actually want to move on. But something really quick. It's very easy for me to miss some things, but I just want you to be well informed. So with the IUL, there's something called the floor, and there's a ceiling. Okay, the floor is 0%. In some cases, it's like 0.25%. In some cases, it's 0.75%. So that means you can never lose more than zero. right? Or your money can never fall lower than 0%. Now in the S&P 500, I mean, we've seen years where the S&P 500 or the stock market has fallen 30, 40%. Not here. Your money will never go before your returns will never go below 0%. Now the ceiling, however, there's going to be a cap. Let's use a proper terminology. It's called a cap. Okay? But the cap is going to be maybe like 14%, maybe 10%. Okay? So your cap, let's say the market there's a bull run and the money does do 20%, right? The max you'll get is 14% or 10%, depending on, relatively speaking, what the market is doing. So that's what we mean by foreign cap, right? You get that protection, so that no loss, but also you get the growth, right? You're still getting growth. You're still getting returns beyond the measly 1 to 3% that your checking account and your high yield savings is giving you. So let's talk about some other principles here. Another principle that I wanted to bring you in is how do you make sure that you are putting your money into the right place for your taxes. So we're going to talk about taxes now, right? So let's talk about taxes. So there's 3 different types of taxes. And this is one that a lot people are very ignorant when it comes to taxes, because I know it can be difficult to understand. But you need to be aware, okay? So there's something that we call tax now. There's tax later. And there's tax advantaged accounts. Either way, the most important thing is to be aware. Don't be an ignorant consumer, okay? Don't be ignorant when it comes to taxes and the impact that taxes has on your money, on your wealth. Tax now accounts are things like your checking account, okay? So your checking account is taxed right now. Another tax now is your savings, okay? So anything with the bank is taxed now. Your stocks, okay? So if you're putting your money into Robinhood, Fidelity, whatever, your stocks are taxed now, okay? Mutual funds, so your 401k. Actually, we're going to talk about your 401k ends up being, no, not taxed later. It is taxed later. So right here, mutual funds, because mutual funds, you can put them in your brokerage account, right? So still mutual funds, right? So that's tax now. Now tax later are things like your 401k, right? So your 401k is growing tax-free, but in your old age is when it's going to be taxed. Now, let me ask you a question. Do you think you're going to be paying more taxes today or more taxes later? Just based on the history of things, right? Is it more likely that taxes are going to remain the same, decrease, or that they're going to increase the tax rates? Now, if we know anything about history, we know that this taxes, the tax brackets, the tax rates, they're surely going to be increasing. So 401k is good because especially if your company matches, that's free money, but be aware of what that might mean for your money later down the line. Okay, so that's tax later. Now, IRAs, right? So your IRA is something that you would still get in your, like your Roth IRA, for example. So not, all right, I don't know what happened. Maybe somebody was calling me, but IRA, what I was saying is that this is different from your Roth IRA in that this is something that you can be getting in your government job through pensions, your IRA. So that's another kind of retirement account. Now annuities, okay? We're not going to talk too much about annuities today, but annuities is a way for you to have guaranteed lifetime income, okay? But that is taxed later. And then your pensions. Your pensions are taxed later. Pensions, that's something that is becoming outdated. People don't really have pensions anymore, but that is something that would be taxed later if you had that. Now, tax advantaged accounts are your Roth IRA. Okay, so Roth IRA after tax dollars, but the good thing about that is that you're not going to pay taxes on that at all. So it's going to be growing tax free, and you get to take out the money tax free once you hit the age of retirement. Okay, now your 529. So if you're planning to take your kids to college, you want to pay for your children's college, the 529 account is tax advantaged, meaning that if you're using it for education related expenses, that money comes out tax free and it grows tax free. Okay. Now your HSA. This is a powerful tool. I would say I have all of these except for an annuity and a pension. Okay. I don't have an annuity and a pension. A health savings account is an account for your health related expenses. This is an account that even when I lose, if I leave my job, when I leave my job, because I do plan to leave my job, I'm still going to have this because this is a powerful wealth building tool. This account is what you use towards health related expenses, but it grows tax free, right? It's tax advantaged, meaning that there's actually an investable portion. You can invest some of that money, but you can also keep some of it as liquid, as cash, so that when you go to the doctor, when you go to buy medication from Walgreens, you have money sitting in there. For even women, your menstrual pads, your sunscreen, your HSA can pay for all of that. Okay, Band-Aids, your HSA can pay for that. Anything, your multivitamins for the men. I'm pretty sure even for like protein, I bet your protein powder can also be HSA eligible. And then that's it, right? That's what I really want to cover. So the key thing here is to be aware of the tax implications on your accounts. Okay. Now, some accounts have zero tax benefits, like all of these here. In your tax now, there's no tax benefit here. Okay. Uncle Sam is not giving you a break for any of this. You are being taxed now, being taxed later, being taxed at every step. However, for the tax later, just know that it is likely that you're going to be in a high tax bracket later on in life, and the tax rates will increase. And the tax advantaged, I mean, this is probably the best, right? There's because this money, although it's your post-tax dollars that are contributed, meaning it's the money that hits your paycheck, that hits your bank account, but that money grows entirely tax-free, which is huge, right? For later down the line. So these are the things that I wanted to share with you today. I know this is getting a little bit long and I have to get back to work right now, but thank you so much for watching. Once again, my name is Adora Kimberly Akachukwu. We go live usually Monday through Friday, 8:30 a.m. CST. Today we were running late, but we go live every day, Monday through Friday. So thank you so much for watching. If you want to see more topics like this, make sure to give me a comment. Let me know what else you want to see, and I will definitely see you next time. Thanks. Bye.